This episode is brought to you by Capital One. Capital One's tech team isn't just talking about multi-agentic AI, they already deployed one. It's called Chat Concierge, and it's simplifying car shopping. Using self-reflection and layered reasoning with live API checks, it doesn't just help buyers find a car they love. It helps schedule a test drive, get pre-approved for financing, and estimate trade-in value. Advanced, intuitive, and deployed. That's how they stack. That's technology at Capital One.
If you're listening to this, you're ready. Ready to join the industrial intelligence generation. A generation defined not by age, but by a shared mindset. To connect teams, accelerate efficiency, and drive innovation. Using the power of Aviva software to reshape industries. Turning real-time insights into real-world growth. Discover our stories at industrialintelligence.com. Join Generation I.
Welcome to today's Q2 earnings results hosted by Rivian. At this time, all participants are in a listen-only mode. After the speaker's presentation, we will conduct a question and answer session. I'll now turn the call over to Derek Mulvey, Vice President of Finance.
Good afternoon, and thank you for joining us for Rivian's second quarter 2025 earnings call. Today, I am joined by RJ Scaringe, our CEO and founder, Claire McDonough, our Chief Financial Officer, and Javier Varela, our Chief Operations Officer. Before we begin, matters discussed in this call, including comments and responses to questions, reflect management's views as of today. We will also be making statements related to our business, operations, and financial performance that may be considered forward-looking statements under federal securities law. Such statements involve risks and uncertainties that could cause actual results to differ materially. These risks and uncertainties are described in our SEC filings and the shareholder letter we filed with the SEC.
Hello, everyone, and welcome to Kilowatt, a podcast about electric vehicles, renewable energy, autonomous driving, and much, much more. My name is Bodie, and I am your host. And on today's episode, we are going to cover Rivian's Q2 2025 earnings call. And this one should be, well, no, I shouldn't say should be, because I actually listened to it all and cut up all the clips. This one's interesting. It's also a long one. It was well over an hour. And I think RJ Scaringe and crew and team had some really good answers to questions and gave some really good insight. I don't know that I have a lot of things to say, like to comment on with this stuff. But the information I think is valuable. I just don't know that my input on it is all that valuable. So this might be one of those rare Kilowatt episodes where I don't talk a lot. And that's probably okay. So we're going to start off with RJ's opening remarks. And there were a lot of mouth noises in this episode. I already cut a bunch out. Like the intro that you heard was a lot of smacking and gross mouth noises. And I cut that out. I was going to cut it out of the entire episode, but the first clip you're gonna hear, I cut it out of, and it took me forever just to do it. So it gets better as the podcast goes on, but just so you know. Also, before we start, I should let everybody know that this podcast or this earnings call was edited so that it makes sense for this show. If you want to go back and you want to listen to what Rivian actually said, I'll put a link in the show notes. All right, let's get to RJ's opening remarks.
Over the past few months, we've made tremendous progress in R2 and our technology, including our autonomy platform. As we move closer to the start of production, our confidence in R2 and future variants underscores our long-term vision for scaling our business. We believe the technology and products we're developing will position Rivian as a market share leader. Our long-term view on electrification and the opportunity in front of us remains the same. However, there have been changes in the external operating environment that affect the nature of this transition. While we believe deeply in the long-term value drivers of our business, the policy environment continues to be complex and rapidly evolving. Changes to EV tax credits, regulatory credits, trade regulation, and tariffs are expected to have an impact on the results and the cash flow of our business. We remain focused on developing world-class technology and efficiently scaling our manufacturing capacity in the United States in light of these policy changes. As we look ahead, Rivian shares the administration's excitement in advancing technology development and manufacturing capacity within the United States. With all that said, having spent a lot of time driving R2, I'm more bullish on this vehicle than any product we've developed. I believe the product market fit is incredible. The packaging, the technology, and overall value proposition set R2 up for meaningful share. R2 is a core focus for our team and a critical step to achieving our objective of delivering millions of vehicles per year. We are currently in the midst of our design validation builds where we're building R2 vehicles on our pilot line. These vehicle builds enable us to validate the performance and capabilities of the full vehicle, along with working with our suppliers on their ramp. Importantly, the quality of the build and associated software stability is incredibly high. We strategically invested in early development assets and mule vehicles, which allowed us to advance development and supplier validation much earlier in the timeline as compared to R1. We have performed a variety of crash tests and component-level tests as well as on-road testing with strong results. In preparation for our manufacturing validation builds later this year, we've completed the construction of our new 1.1 million square foot building in Normal, Illinois, which will house R2's general assembly and body shop. Our team is focused on installing and validating the equipment to support the manufacturing validation builds.
Okay, so as you can imagine, the big topic in this earnings call is the R2 platform, tariffs, autonomy. So these questions were asked multiple times throughout the earnings call, and Rivian gave the analyst a really long time to answer questions. This earnings call went well over an hour, but we have a lot of great analyst questions. But before we get to that, RJ is going to talk about autonomy.
We see autonomy as becoming increasingly important in a customer's purchase decision. By later this decade, we believe ultimately every new vehicle will need advanced levels of autonomy to be successful. Because of this, the development of our Rivian autonomy platform has been one of our most substantial and important focus areas. Our platform uses the high-quality data coming from our best-in-class onboard sensor set to drive our data flywheel for training our Rivian large driving model. We've already seen positive feedback from customers on some of the growing autonomous capabilities. We launched Enhanced Highway Assist earlier this year and are seeing meaningful uptake in the usage of our autonomy platform. With our high-quality sensor set and a large amount of data collected from our vehicles every day, we believe we have the right ingredients to quickly establish leadership in the space. We plan to host our Autonomy and AI Day in December and look forward to sharing the progress we've been making.
All right, in the interest in saving time, I don't really have anything to add to this because we're going to learn more as we get into the earnings call. Let's go ahead and jump back in with RJ.
While we approach some exciting releases across R2 and our autonomy platform, last month we also launched the R1 quad motor, and the feedback has been incredible. We believe the quad elevates our R1 platform, which is already one of the best-selling vehicles in its class. The customers, journalists, and influencers have had a chance to drive the new quad are seeing the unique combination of on- and off-road performance, advancements made with our Rivian autonomy platform, and software features that allow you to customize dynamics with our RAD tuner. With the progress demonstrated this quarter, I can't wait for our Autonomy and AI Day, the launch of R2, and the realizing of our long-term scale potential with our midsize platform. I want to thank our employees, customers, partners, suppliers, communities, and shareholders for their support.
All right, that's a nice little update. I really don't have anything else to add, so let's get to Claire McDonough, who is Rivian's CFO.
During the second quarter, we produced 5,979 and delivered 10,661 vehicles from our manufacturing facility, which was the primary driver of the $927 million of automotive revenue. We saw a significant decrease in production volume compared to the first quarter as a result of a variety of supply chain-related complexities, partially driven by shifts in trade policy. We believe we now have visibility into these components for the remainder of the year. Automotive gross profit in the second quarter was negatively impacted by lower production volumes, which resulted in approximately $137 million of fixed cost included in cost of revenues as compared to more normalized volumes. Automotive gross profit losses were $335 million. Our software and services segment reported another strong quarter with $376 million of revenue and $129 million of gross profit. About half of the revenue within software and services was a result of the software and electrical hardware joint venture we created with Volkswagen Group. We also experienced strong growth and gross profit contribution from remarketing, service, accessories, and charging. Our consolidated revenue was $1.3 billion, and gross profit losses were $206 million. Included in this was $185 million of depreciation and $37 million of stock-based compensation expense. Adjusted EBITDA losses for the quarter were $667 million. We saw a slight increase in overall operating expenses in the second quarter as compared to the first quarter, driven by the ongoing investments we're making to develop R2 and our key technologies, as well as the continued growth of our sales and service infrastructure and organization. We expect to see increasing operating expenses in the second half of the year as we advance R2 towards production and continue the build-out of our sales and service infrastructure to support R2's volumes. During the second quarter, we also strengthened our balance sheet. On June 30th, we received a $1 billion equity investment from Volkswagen Group at an effective price per share of $19.42, which represents a 33% premium to the $14.56 30 trading day volume-weighted average stock price. During the second quarter, we also refinanced our senior secured notes due October 2026 by issuing $1.25 billion of green secured notes at a rate of 10% maturing January 2031. In addition to the $7.5 billion of cash and cash equivalents and short-term investments reflected on our balance sheet, we expect to receive up to an additional $2.5 billion of incremental capital associated with our joint venture transaction, as well as an up to $6.6 billion loan from the Department of Energy associated with the build-out of our Georgia facility. Turning to our 2025 guidance, we are maintaining our delivery guidance of 40,000 to 46,000 vehicles and our CapEx guidance of $1.8 to $1.9 billion. As a reminder, we plan to shut down our normal facility for approximately 3 weeks starting in September of this year to prepare for the planned launch of R2 in the first half of 2026. We anticipate the third quarter to be our peak delivery quarter of the year across both consumer and commercial vehicles. As RJ mentioned, while we believe our long-term opportunity to drive meaningful growth and profitability remains strong, some of the recent policy actions will have an impact on our results and cash flow of our business. This includes increased tariffs, which had a minimal impact during the second quarter, but are expected to have a net impact of a couple $1,000s per unit for the remainder of 2025. In addition, due to changes in certain regulatory credit programs, we do not expect to earn revenue from these programs for the remainder of 2025. We expect total 2025 regulatory credit sales to be approximately $160 million, as compared to our prior outlook of $300 million. As a result of the changes in our regulatory credit outlook, in addition to our second quarter results, we expect our gross profit for the full year 2025 to be roughly break even. We are also increasing our guidance for our adjusted EBITDA loss to $2 to $2.25 billion as a result of the modifications to our gross profit outlook. Our focus remains on cost optimization and efficiently scaling the business. We are actively studying tariff mitigation strategies to best position the company, especially as we look ahead to the Section 232 automotive tariff offset, which ends in April 2027. We remain steadfast in our belief that R2 and our technology development will be truly transformative for our growth and profitability.
All right. I don't have a lot to add to this. Obviously, the trade policies that are implemented by the Trump administration, we've heard it from all of the other earnings calls that we've listened to this point, have thrown a wrench in the businesses, and they've kind of had to figure it out how to work around them.
It's that time of year again, back to school season, and Instacart knows that the only thing harder than getting back into the swing of things is getting all the back to school supplies, snacks, and essentials you need. So here's your reminder to make your life a little easier this season. Shop favorites from Staples, Best Buy, and Costco, all delivered through Instacart, so that you can get some time back and do whatever it is that you need to get your life back on track. Instacart, we're here.
This episode is brought to you by Capital One. Capital One's tech team isn't just talking about multi-agentic AI, they already deployed one. It's called Chat Concierge, and it's simplifying car shopping. Using self-reflection and layered reasoning with live API checks, it doesn't just help buyers find a car they love. It helps schedule a test drive, get pre-approved for financing, and estimate trade-in value. Advanced, intuitive, and deployed. That's how they stack. That's technology at Capital One.
How many times have you wished you could be in two places at once? With Wix, you practically can. Wix's website builder is packed with powerful AI tools to make running your business online easier. Build a full site just by talking with AI. Get an AI agent to manage your sales and marketing. Or work like a 10-person team, even if it's just you. So you don't need superpowers to get everything done. You just need Wix. Try it now for free at Wix.com.
Businesses that are selling through the roof, like Untuck It, make selling and for shoppers buying simple with Shopify, home of the #1 checkout on the planet. And with Shop Pay, you can boost conversions up to 50%. Businesses that sell more sell on Shopify. Upgrade your business and get the same checkout Untuck It uses. Sign up for your $1 per month trial period at shopify.com/podcast free. All lowercase. Go to shopify.com/podcast free to upgrade your selling today.
All right, let's get to our first analyst question.
Our first question will come from Dan Levy with Barclays. Your line is open. Please ask your question.
Hi, good evening. Thanks for taking the questions. I want to start with a question I think that's probably on everyone's mind, which is just bridging from R1 to R2. And I think the obvious key here is the cost reduction. You're saying you can cut the cost by more than half. But maybe you can just remind us again, about what are the things in R1 that won't recur? And, on the flip side, you're talking about things like sourcing and contracts that can help on R2. What is the conviction that you can get the required cost reduction from these items to get appropriate economics on R2?
Thanks, Dan, for the question. This is incredibly important, and it's been an absolute core focus for us as a business as we've been developing R2. And if you think about the cost on the vehicle, there's two major drivers. The first is our bill of material costs. So it's the cost we're paying all of our suppliers for the components going into the vehicle. And the cost of those components reflects how the vehicle is being designed, how the systems are being integrated. And we talk a lot about this, but our success in either consolidating parts or eliminating parts through design is a big enabler here. And we previously said the bill of material cost on R2 is about half that of R1. And that's not a hope, that's not a wish, that's actually contractually negotiated with suppliers. And so we've spent the last 2 years of development and time negotiating with suppliers to put in place contracts that we both selected suppliers that can scale with us and ramp appropriately, but also can deliver a much lower cost structure. But linked to that, of course, is then how the vehicle assembles. And so the cost it takes us to convert all those parts into a vehicle, or we often call conversion cost. And then some of the non-bill of material COGS, that's logistics, that's warranty accrual, that's some of the other items that feed in. And here, Claire and I both spoken about this. Claire, Javier, and I have spoken about this on these calls before, where we're projecting with a lot of confidence that will be ultimately less than half of what it is on R1. And that's really reflective of an incredibly high focus on ease of assembly, design for manufacturability, leveraging the many, many learnings that were born out of what we went through on R1. So simplified body architecture, simplified closure systems, further simplifications, the network architecture and associated wiring harness. And in totality, what that gives us is a vehicle with a much lower cost basis, which supports the dramatically reduced pricing of R2. And of course, it should be said, R2 is a meaningfully smaller vehicle than R1. It does deliver on the brand promise of Rivian, but we've been very thoughtful on some of the content decisions we've made, where it's not as extreme in terms of performance or capability as what you see in R1.
All right, I think they'll say this. Anytime I've had the opportunity to listen to somebody from Rivian speak, they're super smart. Anytime that I've had the opportunity to talk to somebody who works at Rivian, very, very smart. Like, these people know engineering, they know production. When I say these people, I mean the people as a group. So what I'm about to say will surprise none of them, but you don't know what you don't know, right? They've obviously made several R2s, but once you get into volume production, you don't know what's going to pop up. You might have an issue with the vehicle. You might have an issue with the production. You might have a supplier that can't keep up, and now you got to switch to a different supplier. There's all of these things that play into this. But I think Rivian has positioned themselves into being able to overcome this kind of thing. RJ Scaringe, not Elon Musk, right? When he talks, he's more measured and fair about things, and he's complimentary to other EV and auto manufacturers and stuff like that. And before Rivian finished their, outfitting their Normal, Illinois facility, which already existed, they just bought it and then they had to move all the equipment in. They were like, we're going to do all of these things to make production easier. And they did. But then they ran into snags. And that's not because they didn't plan for it. That's because these kind of things just happen. In this instance, we have a much more experienced team. They had to overcome a lot of obstacles with the R1 platform. So I'm confident that when they say they'll be able to bring this car in at the cost, at the price that they set, which was around $45,000 to $50,000, I'm confident that they're going to be able to make that. All right, let's move on to our next question.
Our next question will come from Adam Jonas with Morgan Stanley. Your line is open.
Hi, thanks everybody. My first question is on the $6.6 billion loan with the Department of Energy that's associated with the build out of Georgia. Can you confirm, has any of that loan been drawn? And is there a scenario where you would decide not to draw on that loan? Because from the readings of the shareholder letter, I don't see much of an update on CapEx going into the build out at this point. But just maybe kind of where are we on that? And what's your thinking on that loan? And then I have a follow up.
Sure. Thanks, Adam. So as it pertains to the Department of Energy loan, it's more of a construction finance, project finance based loan. And so it does require Rivian to be deploying capital on site in Georgia. We've not yet started construction of the site. And so that precludes us from having the opportunity to draw on that loan as we sit here today. And as we look at the future roadmap, the attractive cost of capital that the Department of Energy loan affords Rivian is something that's quite attractive to us. So we do intend to draw on that loan as we look to expand our manufacturing base in Georgia.
Okay. This one's a tricky one because this loan was actually issued under the Department of Energy when President Biden was the president, obviously. So what we have seen with the Trump administration is they are rolling back what seems like haphazardly rolling back certain things that the Obama administration put in place. So if I were Rivian, I would want to spend that money as fast as humanly possible, just in case it becomes a target for the Trump administration. And then again, he wants manufacturing in the U.S., so he might just leave it alone. We'll see. Our next clip is an interesting one because it's about Also Inc., which is Rivian's micro-mobility arm, which I did not know existed until this earnings call. So let's listen to that.
You spun off Also Inc. in March of this year, your micro-mobility unit. You seem to have attracted some pretty serious talent to that unit as well. And I think there's probably more announcements to come there, I would assume. aside from the minority stake held by Rivian, and maybe you can confirm how big that is there any other relationship between Rivian and also Inc. And how much time, RJ, are you spending on this entity with your current role as chairman? Thanks.
Yeah, thanks, Adam. We had a skunkworks project within Rivian that was looking at essentially to the question of how do we electrify the world? What's necessary? And a natural conclusion of that is, of course, there's markets like the United States and Europe that are very vehicle centric, but not only within those markets, but beyond those markets, much of the world moves on things that look very different than cars. So 2-wheel, 3-wheel, even 4-wheel quadricycle type products. And so the initial effort that when it was housed within Rivian was to look at ways that we could take this technology base that we developed and apply it into the micromobility segment. As we were doing that, we realized the market opportunity was very significant, and in fact, bigger than we had originally anticipated, and took the decision to move that outside of Rivian, where Rivian is still a significant shareholder, but allow it to secure outside capital and allow its brand trajectory and company trajectory to look at markets differently, positioning differently than the Rivian product line. And what's been really interesting is just the scale of that in terms of what it represents in number of vehicles is really exciting. And so Rivian, as you said, is still a very significant shareholder, just under 50% ownership in this entity. But we continue to have a lot of the technology that also is using leverages some of the core of what Rivian built. And when you think of the opportunity, I think there's going to be ways that we can be really creative, where we see the Rivian product line and the Also product line coming together. We often think about them as two Avengers, or both fighting for the same mission. If you want to electrify the world, of course, Rivian's part of that. We hope to inspire competition in the vehicle space, but we also, hence the name, we also need to electrify a lot of other things, 2, 3, 4-wheel things. And that's why that company exists.
I went to Also Inc.'s website, and it really doesn't give a lot of information on what they're doing. We can assume they're working in the, bicycle space. Maybe a quad bike or a trike would be interesting. But yeah, I'm kind of curious as to what this company ends up putting out. All right, let's move on to our next question.
Our next question will come from Daniel Rosa. Your line is open. Please ask your question.
Hey, thanks for taking my questions. I'd like to double click a little bit on Dan's first question on the EBITDA break-even in 27, because it does seem that there are quite a few meaningful headwinds, especially in the near term, and some of the items you talked about seem like they're more long-term opportunities. So I'm just, maybe you could go back and comment a bit on 27, because, we're losing the EV credits. Loss of the IRA and purchase incentive could be almost 10 to 15% of an R2 purchase price. The Volkswagen partnership, if I recall correctly, doesn't have financial upside other than the disclosed amounts that are kind of baked into the guidance. And even more partnerships are highly unlikely to materialize by 27 if you're willing to integrate a full kind of electrical architecture into a new car. So I'm wondering here, with those headwinds, shouldn't we expect the EBITDA break-even to move into later years, given the plan we discussed last year?
Thanks, Daniel. Claire and I will speak to this one. I think first and foremost, we did speak a little bit earlier in the call on this, but the R2 cost structure and the way that we've developed the vehicle provides us with a platform, a cost platform that's just materially different than where we've been on R1. And along with that, a number of factors, since we talked about this before, despite some of the headwinds, we've had a number of factors that are actually positive movements for R2. And Claire referenced this, but first and foremost is the ability to look at joint sourcing of some of the electronic components that are used in R2. And of course, some of those components will be used across the Volkswagen Group as well. We've also, as Javier noted, are now in a position where the bill of materials on R2 is sourced. It's no longer something that we hope we can achieve, but in fact, we've been able to put that together. And as we now look at continuing to grow those relationships with suppliers and thinking about 2027 and beyond, the whole supply base, ourselves, everyone has been looking at ways to drive cost efficiencies into the business to address one of some of these major headwinds that have occurred in terms of tariffs and tariff structure. And by 2027, there's a lot of plans or offsets that are being put in place by us, by our suppliers, to address those specific headwinds. As you called out, the EV credits environment, which for us was a meaningful source of revenue, where we would sell our excess credits to other manufacturers. That being reduced is a short-term reduction in positive cash. But on the flip side, we also now have an environment which we believe we'll start to see in 2027, where a lot of the manufacturers who are choosing to earn their own credits by incentivizing sale of electric vehicles, they'll be less incentivized. So I've said this many times, but the long-term level of competition in the EV space is going to be inherently lower. There's less incentives for incumbent manufacturers to make the commitment or the transition to electrification. And when we look at all those things together, there's of course some puts and some takes, but we still believe achieving the 2027 positive EBITDA is the target we need to be driving towards. Is what Claire talked to. We're pushing extremely hard to get there, and recognizing that we have time to react to some of these changes.
The other key driver is as we look at the broader software and services opportunity, this is an area where we do anticipate there being significant growth over the course of the next 2 years, especially as we recognize greater levels of revenue from some of the background IP consideration, which is associated with the progress occurring within the joint venture and getting Volkswagen vehicles out on the road and into the wild, which is one of the key contributing factors as we think about the relative contribution of both the automotive business from a gross profit standpoint, which is driven by R2 and the continued scaling of the normal plant, as well as the software and services opportunity from the joint venture, coupled with the broader opportunities that we have as we continue to scale and grow the car park and achieve additional gross profit and ultimately contribution to our EBITDA target from things like our remarketing program and the sale of used Rivians, from our charging network, from the growth of our service infrastructure, financing, insurance, and in future state autonomy is another driver of some of that roadmap as well.
I don't think that it's a big deal that the $7,500 federal tax credit is going away. I think consumers are going to continue buying electric vehicles, if for no other reason than it's cheaper than buying gas. If you can charge at home or in your apartment complex for a reasonable rate, it's cheaper than gas, right? At the moment, my my garage door broke a spring. So I can't get him to my garage to charge my car. So today I had to go to the supercharger. And I went when the rates were a little bit lower, but I still paid pretty close to $20 to charge my car from, I don't know what the percentage was, but I went from like 40 miles on the battery to 220 miles on the battery. And that was still fairly close to $20. I don't remember what the exact price was, but doesn't really matter because if I was filling up a car that was equivalent, that was a gasoline vehicle, it would have been more. But it's still more than it would have cost to charge in my garage. So right now, when I charge, I think I pay like $27 a month to charge my car at home. That's pretty cheap. I don't have to go to the superchargers very often, maybe twice or maybe 3 times in a year. It's not like a regular thing for me. It might be a regular thing because they came out to fix the spring today. And they're like, oh, you have wooden doors. These things weigh like 400 pounds. We don't have springs that will open that. We're going to have to special order those. So I'll be out of a garage door for a little bit longer. But anyway, the point to this is people don't want to pay more money than they have to. I think people are more accepting of EVs. So I don't think it's going to affect EVs in the long term. Now, for the next quarter or two, I do think we'll see a dip. But once we kind of forget that there was a $7,500 tax credit here in the US, then I think sales are going to rise back up to at least where they are now, probably higher than this over time. But I do think there will be a dip, and there'll be lots of stories about how electric cars are over, because the same thing happened when they took the tax credit away the first time. Right around that time, Tesla was the only one that qualified for it. But it's one of those same story, different day kind of things. Also, I think a haboob is coming in. If you don't know, that's a giant dust storm here, because the trees outside my window are going crazy. So hopefully the power stays on. Let's see. I'll keep you posted as we go through this.
This episode is brought to you by Capital One. Capital One's tech team isn't just talking about multi-agentic AI. They already deployed one. It's called Chat Concierge, and it's simplifying car shopping. Using self-reflection and layered reasoning with live API checks, it doesn't just help buyers find a car they love. It helps schedule a test drive, get pre-approved for financing, and estimate trade-in value. Advanced, intuitive, and deployed. That's how they stack. That's technology at Capital One.
El rugido de los aficionados, el ritmo de las porras, la intensidad en la cancha. Esto es más que solo un partido de fútbol. Con DraftKings Sportsbook, esta es tu oportunidad de convertir cada jugada en una gran ganancia. Descarga la app de DraftKings Sportsbook y usa el código HEART. Ese es el código HEART para que los nuevos usuarios reciban $200 en bonus bets al instante cuando apuestes solo $5. En asociación con DraftKings, la corona es tuya. ¿Problemas con el juego? Llama al 1-800-GAMBLER. En Nueva York, llama al 877-8-HOPE-NY o envía un mensaje de texto con la palabra HOPE-NY al 467-369. En Connecticut, hay ayuda disponible para problemas con el juego. Llama al 888-789-7777 o visita ccpg.org. Juega responsablemente. En nombre de Boot Hill Casino Resort, Kansas. Debe ser mayor de 21 años. La elegibilidad varía según la jurisdicción. No válido en Ontario. Pueden aplicarse cargos en Illinois. Las apuestas de bonos son de un solo uso. La apuesta no se incluye en las ganancias y caducan después de ser otorgadas. La oferta finaliza el 29 de septiembre 2025 a las 11:59 p.m. hora del este. Los términos en DraftKings.com/sportsbook/promos.
Let's go ahead and jump into our next clip.
Our next question will come from Joseph Spak with UBS. Your line is open. Please ask your question.
Thanks. Good afternoon. Maybe just two quick clarifications and then a bigger picture question. Like you previously on these earnings calls have said you were baking in several $100 million in policy impacts, which I know was vague, but I think was interpreted and suggested as tariffs and some regulatory credit. So I know you just lowered regulatory credit to basically not assuming anything in the back half. That seems like it's maybe half the EBITDA reduction. But what exactly got worse on tariffs? And now you see it a couple $1,000s per vehicle higher. And then just the other clarification on the 27 EBITDA target, which I know came up a couple of times, since I guess the regulatory credits are the one thing you're willing to concede has changed. Like, how much was actually baked into 27 for that number?
Just wanted to clarify on your first question, Joe. The couple $1,000s a unit on tariffs is consistent with the commentary that we provided last quarter. So there's no change overall in terms of the outlook from a tariff impact on the business as we look at the 25 impact. So the incremental impact, as we mentioned, is real from a policy standpoint, is really driven by changes in the regulatory credit outlook, where we no longer anticipate we'll be selling, or earning revenue from the sale of regulatory credits in the second half of this year, given changes to certain regulatory credit programs that have occurred of late. As we look at the broader guidance, the other impact is, as we talked a little bit about in our prepared remarks, was just driven by the Q2 overall performance and some of the supply chain related complexities that limited our production volume this quarter in particular. As we look at 2027 EBITDA, we're not going to get into specifics in terms of what was in and is now in the overall outlook from a regulatory credit standpoint. We fully acknowledge that the bar has risen given some of the policy-related headwinds that we're now working through as a business. But our objective is to continue to drive towards positive EBITDA through a number of ongoing initiatives to drive cost efficiency into the business and to ensure that we have an efficient ramp of R2.
All right. We have talked about regulatory credits several times over the last couple of weeks, so we're going to skip past that. If you don't know what it is, let me know. Just send me an email and I'll explain it to you. But I think everybody's pretty familiar at this point. Let's go ahead and move on to our next question.
You're taking 3 weeks downtime here in September to get normal capacity to 215K. You're currently producing at, I don't know, probably below 20% of that utilization right now. So and I realize it's not fair because you have much higher volume hubs for the R2, but I guess at what level of utilization do we need to see it normal before you really start thinking about commissioning Georgia?
Step in real quick because this question might not make sense. He's asking at what level of utilization do they need in their normal plant before they start building on their Georgia plant, which they got the Department of Energy loan for. All right, let's get back to the answer.
It's Joe. It's a great question. We think about the normal facility. We've talked about this a lot in the past. It's ultimately going to be producing R1, R2, and our commercial van. And as we look at some of the variants on the R2 and R2 platform, what that does with bringing on the Georgia facility is it not only expands capacity, but allows us to build some of these additional variants and further grow both the addressable market and importantly, fill in where we see some real volume opportunities. But with regards to Georgia, we are building that across 2 phases, and we're going to be starting construction on the Georgia facility. In terms of the building, of course, a lot of work has happened on the site and preparing the site, in close partnership and in conjunction with the state of Georgia. But we're starting going vertical on buildings in the early part of 2026.
Okay, that's good to know. They're also planning on getting, R2 shipped and out the door to customers in 2026. So that's a good sign. Now, of course, the initial R2s will be built in Normal, Illinois. And if the R2 sells as well as they would like it to, I'm sure that factory in Georgia will take up some of those vehicles. Okay, update on the Haboob. It is now darker than it was 6 or 7 minutes ago when I first told you that it's getting windy outside. It went from being very sunny to kind of dull and gray. All right, let's move on to our next analyst question. Don't worry, though. I'll keep the weather updates coming on the 15s.
Our next question will come from Ron with Guggenheim Securities. Your line is open. Please ask your question.
Yeah, good afternoon, and thank you for taking my questions. A bit of a follow-up on some of the policy changes, but has any of the impact of these policy changes, whether it's emissions or consumer credits, changed how you view the R2 or R3 with respect to whether it's pricing, costs, or how much capacity is needed? And I know that there's some sensitivity around the pre-order number for the R2, but if you'd be willing to share an update, it probably would go a long way in kind of assuaging concerns around the needed capacity with Georgia.
Yeah, I mean, we're not going to share the number here, but I have said a couple times. I mean, we're extremely bullish on R2, and a big part of developing a product like this is an enormous amount of effort. A lot of iteration has gone into defining what the product is. A lot of work understanding the size, the pricing, the cost structure, the content. But where we've landed in terms of what we'll be starting production on here shortly is something that we feel has an outstanding product market fit in the heart of the demand curve, meaning price points overlapping with the largest segment, the form factor overlaps the largest segment, and the feature and content is really incredible. And so what that means in our view is this is going to be cross-shopped across the broadest spectrum of possible variants, most of which actually are ICE vehicles. So customers will be making a consideration that maybe haven't made the jump to electrification, but would like to, but wanted maybe something that was more of an SUV form factor, wanted to spend $45,000 to $50,000, and that hasn't existed in the market. And so we do see, the scale of the addressable market as being, many, many millions of units. And so with what we're launching in Normal, representing 155,000 units of R2 capacity, and then what we'd be bringing on in Georgia for the platform, which, of course, by me saying that, it implies variants of that vehicle, adding another 200 in the first phase, we feel quite confident and bullish on what that represents. It's also worth noting that, and we've said this in the past quite a bit, the R2 and the platform are designed to support both the U.S. and European markets. And so not only will be opening up this vehicle across many more price points and a much bigger addressable market in the United States, but ultimately this platform is going to support opening up access to a very large market, which is Europe. And so, of course, follow-up question, I'm sure what you're thinking now is, what do we think about U.S. EU trade relations and what is going to happen there? We're watching that very closely. Certainly, there's been some positive movements on that for us, being that we'd be exporting these vehicles from the United States to Europe, but we have to continue to watch that very closely.
When he says that the R2 platform was designed for North America and Europe, don't read into that as the R2 vehicle that they have is designed for North America and Europe. It might very well be, but it may be also that they're planning on a separate or a different vehicle for Europe. That's not the R2 that we know and are hoping to have in our garages here in North America. It may just be something that is more friendly to what Europeans like to buy, if I had to guess. I think the R2, and I haven't seen it in person, but I think the R2, the North American R2, is maybe a little bit big for most of Europe. I could be wrong. Okay, actually, I might be wrong. So I went to Google, and these are Gemini answers, but I wanted to know what the size of the R2 was versus the size of the Model Y. So the R2 is 185.6 inches. The Model Y is 187, so not that long. The width of the Model Y and the R2 is 75 inches. The Model Y is just a little bit wider. And the height, the R2 is a little bit taller at 66.9, whereas the Model Y is right around 64. And I might have said 62. It's 66.9. So, yeah, comparable to the Honda CR-V. So ignore everything I just said, and let's go to the next question.
Then on the technical aspects of your approach to autonomy, excited to see what you have in store for us later this year. But some of your competitors are opting for camera only, as you're well aware. Some are opting for more hardware-heavy approaches with LiDAR or even beyond that in terms of the hardware required. I guess, what gives your team confidence that your early sensor fusion approach to autonomy is the correct one?
Yeah, I think it's an important question. I do think that this question of what's the sensor set topology gets more attention than it really should. I think the approach of using an early sensor fusion, which is just a different way of saying an AI-centric approach, meaning if you think of like how systems were developed prior to 2021, and when I say systems, essentially every self-driving platform developed prior to the use of transformer-based encoding, was you would have a set of sensors that may include more than just cameras, but whatever that set of sensors is, each sensor would identify objects, classify those objects, and associate vectors with those objects. And all those identified objects and their associated vectors would then be passed to a planner, and you'd make a whole series of rules-based decisions around what the vehicle should do and decisioning around which sensor set to actually follow or trust. In that late fusion process, had some of the challenges I think you're alluding to of having to decide around what's your primary sensor path and what are the risks and associated challenges with using some of the other sensors. As you move to something that's much more AI centric, you have to think of it very differently. Think of it as you have an enhanced view of the world, an enhanced view of reality as early as possible. So raw feeds going directly into inference. You can create a better understanding of the situation and the circumstance. And the neural net, the large model that we build around this, then drives ultimately how the vehicle performs. And we do that through the use of a very large data flywheel with our deployed fleet, providing triggered data back into our back to us, which we then use to train to build this large parameter model that ultimately determines how the vehicle behaves in these situations. And so I think ultimately that this debate around which sensors are used, I think often it's maybe based on cost structures that are no longer in existence. LiDARs, radars, these things are not as expensive as they once were. And it allows us to build a much richer understanding of what you can see, what the vehicle sees at the early stage, at a base level, as we start to make decisions through the model, through this large foundation model in terms of what the vehicle should do. And I often draw the analogy to say what's helpful here is it's accretive, meaning if the sensors get better, you don't throw away the model as we once did. The model has a more precise understanding of the world. And the best example is, imagine you learned how to drive without glasses and you had poor vision, and then suddenly I handed you a pair of glasses. It wouldn't be as if everything you knew up until that point was obsolete. In fact, you would just have a more accurate view of the world and be able to make better decisions through your neural net, through your brain, which has processed how the world behaves and drives. And so it's no different as you increase the quality of the cameras. That's both in terms of breadth of performance, low light to high, bright light, then also details in the camera. So increasing levels of megapixels, which is important for us. We go from 55 megapixels in R1 to 65 megapixels in R2. But it also pertains to additional sensor set, which allows in another modality that has non-overlapping strengths and weaknesses with a camera set to also have a perception of the world. And so if you were to give me a LiDAR or a radar and bolt it onto my forehead, I would be a better driver as a human, but it wouldn't negate or throw away or make obsolete all of my accumulated knowledge to date.
Oh, okay. I'm not sure the glasses analogy is the best to use, but I don't have a better one. But I want these automakers and these autonomous driving companies, I want them to try different things. I want them to do something different than what Tesla or Waymo is doing, even if it's just a little bit, because I don't think any of these companies is close to solving autonomy. I think that we're still ways away. So since we're in this early stage, let's find out what works and what doesn't work. And, later on, 10 or 15 years from now, maybe some graduate student will be shuffling through some papers and maybe like, you know what, I think we have the technology to give this one thing another try. And, it turns into a huge business for them and it makes the cars on the road safer. I'm all for that. Okay, let's move. Oh, you know what? Weather update. The wind has kind of stopped, although occasionally it'll get kind of violent, but it's the calm before the storm. It is darker than it was outside and a little more gray. Like if this was a horror movie, it would be the foreshadowing moment. So if something bad happens, y'all go on without me.
Maybe just as a quick follow-up, I know we touched on autonomy and the different technologies and use cases. I'm just wondering if you can maybe give us your vision in terms of kind of the initial ramp up of that developing, any granularity that you might be able to provide. And then also, here's a question. Are you considering autonomy for the EDVs potentially? Just curious if you're considering maybe commercial self-driving as well. Thank you.
The EDVs are the electric delivery vans, like the Amazon vans.
Andres, this is by a significant degree one of our biggest focus areas. And I alluded to this and talked to this before, but just to be very explicit, the approach that we're utilizing on autonomy is represents a significant shift, a significant step. You often hear it called like AV 2.0 relative to what was done prior to like 2021, 2022. And so what we launched with on R1 with our Gen 1 vehicle is a completely different topology, different sensor set, different compute stack, completely different software architecture to what we now have on our Gen 2. And so what we designed our Gen 2 vehicle with was a much higher level of compute. So it's inference on vehicle, much more capable cameras. We brought all that perception stack, the camera set in-house. Of course, we designed the compute platform to support that really rich camera set that I talked about earlier. In the case of R1, that's 55 megapixels of cameras with outstanding breadth of performance. And really the goal of that, which launched a little more than a year ago now with the Gen 2 vehicles, was to create a data platform to train a very capable model. And that very capable model, of course, gets better as the fleet size grows. And when we say train, I want to be specific here. It's not just having vehicles with lots of sensors and a lot of inference on board. The way that we trigger what data gets sent back to us. So what are the triggering events? Of course, it's when the vehicle encounters an issue, when it disengages from its autonomous driving mode. But importantly, when you're not in autonomous driving mode, what's triggered? What are we doing to find interesting situations that fill in and add robustness to this large model we're building? And so we've really spent a lot of time defining a whole array of different triggering events that allows us to pull data off of our deployed fleet, use it to build robustness into the model, and then redeploy that model in the distilled version back out to the vehicles. And that's what customers are starting to see in terms of improved feature set. And we are deeply of the belief that this approach of an AI-centric approach, what you may often hear called like an end-to-end approach, where you're training based upon the behaviors of the vehicles, is the approach that's going to win. But it does require you to control the perception stack. It requires you to have a very robust data triggering architecture. It requires a very robust data movement architecture, meaning your vehicles are ideally connected to Wi-Fi, which allows much lower cost movement of lots of data. And so the incentive structures we've put in place around having customers on Connect Plus and having them Wi-Fi connected helps drive that. But that feeds, our offline training that's occurring on, of course, on lots and lots of GPUs, which then continues to get better and better. And so that set of ingredients, we think very few manufacturers have. We're investing tremendously into it. And what we'll start to see in terms of customer-facing features is, first and foremost, we'll see the vehicles be able to operate under a much wider range of roads. So today we limit our feature to a highway feature. In the not too distant future, we'll go map free. And what we say that, but what we really mean is it can operate essentially anywhere. And we've already gone hands free in certain conditions on highways. We'll broaden that to be more conditions. So eyes on, hands off. And of course, the next step as we look into 2026 is identifying specific areas where you'll go hands off, eyes off. And so where you'll truly get your time back, where you can be looking away from the road, not an active participant anyway in the operation of the vehicle. And coupling that with a turn-by-turn capability. So you get into your car, you can imagine the future state where the car, then you give it the address and it takes care of getting there. And so that is as we think about what's the roadmap for the next couple of years, that's what we're driving towards. Core to that is this building of a large model. Of course, that model has applications beyond just R1, R2, and beyond, as you referenced. There's applications in the commercial space and with our commercial vans. And so we're very, very excited about what this represents in terms of the business opportunity it creates, but also the customer experience it forms.
I don't know that the way that they're doing training, right? Like when you're in autonomous driving mode and something happens, the information gets sent back to Rivian. But also if something happens and you're not in autonomous driving mode, something happens and it gets sent back to Rivian. Tesla does this, and it doesn't sound like they're doing anything new. Obviously, I'm not a Rivian employee and I don't have privileged information, but from what I can gather, does not sound like this is all that different than what Tesla's doing, and I'm sure a bunch of other autonomous driving companies are doing. But I love that they're doing it. Let's go on to our final analyst question.
News to share on commercial vehicle momentum, any additional wins or traction there? Thank you.
There's been a few vehicle sightings that are different than the Amazon vehicles, but I think the most important thing here, and Claire referenced it, I said it as well. We continue to work very, very closely with Amazon. They're an outstanding partner. Of course, they're a major shareholder in Rivian as well, and we are seeing more deliveries of our vans with them through the second half of this year. The partnership continues to be very healthy, great close relationship with the users of the vehicles, the drivers of the vehicles, and the operators of the vehicles. And that continues to allow us to make improvements and tweaks to the vehicle such that, we hoped to achieve this a few years ago when we were developing the vehicle. We can now say this with confidence. It's the best platform for logistics and commercial delivery, bar none. It's an outstanding product. And so to be able to harden that product and refine it in conjunction and partnership with Amazon has been great. And, we do think as other fleets start to electrify, they'll see this as a great choice.
I've seen some Walmart delivery vans running around that are Rivian vans. So, yeah, it's always interesting to see them in a different color because you're so used to seeing them with the Amazon livery on it. Seeing the bright yellow and blue and white Walmart is a little shocking, but still looks good. Like, I'm so used to seeing the Rivian vans in my neighborhood. I was yesterday or today, I was out doing some work in the yard and I saw an Amazon van drive by, like the BMW van or whatever, Mercedes van, whatever that you're using. And it took my brain a second to register that it was an Amazon van because it was just weird. So they're pretty ubiquitous here. Okay, so that is the Rivian earnings call. It was a long one. I hope you all enjoyed it. I think we learned a little bit. Out of all the earnings calls that we covered this quarter, I thought that Rivian's was the best. They kept their opening remarks. Claire and RJ kept their opening remarks somewhat brief. We got a lot of time with analysts. They got to ask a lot of good questions. I didn't put every single question in there. If you want to listen to the entire earnings call, I'll put a link in the show notes. But yeah, that was good. It was a good earnings call. So, all right, everybody, that is it for me. In terms of episodes this week, you're going to get more than 2. I don't know quite how many, but I have a lot of news. I have over 100 articles that I got to sort through and get out. Of course, I'm not going to put out 100 articles this week. Some of them are repeats and some of them I'll just get rid of altogether. But yeah, it's a busy, very busy time of year for EVs. Go figure. I hope you all had a wonderful weekend, especially those of us in the U.S. who are having a long weekend. And I will talk to you at least 2 more times this week.
This concludes the Q&A section of the call. I would now like to turn the call back to RJ Scaringe for closing remarks.
Thanks, everyone, for joining us today. Hopefully, you're hearing just the enormous excitement that we have for R2, the state of the program and the health of the program in terms of its cost structure, its development status, the close work that we're doing with the suppliers, as Javier both spoke to. These are fully engaged suppliers that are working with us in the development of the vehicle. You're also, if you're living in the Bay Area, Southern California, you're probably starting to see these camouflage vehicles out on the roads. It's certainly exciting, but we're really focused on getting the vehicles ready for a very smooth and very healthy launch of the product. And along with that, the focus that we have on building out our autonomy and self-driving platform, we'll see that make continued big steps forward on the R1 vehicle. And as we launch R2, with the further enhancement to our perception stack, we'll see, again, really leadership in the R2 vehicle around our self-driving platform. And so those are core efforts for us, and really, we think, create an outstanding future state for us. And we are very, very bullish on R2. We're very, very bullish because of that on the outlook for the business. And we appreciate everybody's support and everybody joining this call.
Quick weather update. It looks like it wasn't a hoboob. We'll see what happens.
This episode is brought to you by Capital One. Capital One's tech team isn't just talking about multi-agentic AI. They already deployed one. It's called Chat Concierge, and it's simplifying car shopping. Using self-reflection and layered reasoning with live API checks, it doesn't just help buyers find a car they love. It helps schedule a test drive, get pre-approved for financing, and estimate trade-in value. Advanced, intuitive, and deployed. That's how they stack. That's technology at Capital One.
Your business is one of a kind, so your website should be too. With Wix, it's easy. Almost too easy to create a website that's perfectly yours. Just tell AI what kind of site you want to build, or choose from thousands of templates. Change whatever you want, whenever you want, and get everything you need to start running your business your way. No matter what you sell or what you aspire to be, you can do it all yourself on Wix. Go to Wix.com.
Businesses that are selling through the roof, like Untuckit, make selling and for shoppers buying simple with Shopify, home of the #1 checkout on the planet. And with Shop Pay, you can boost conversions up to 50%. Businesses that sell more sell on Shopify. Upgrade your business and get the same checkout Untuckit uses. Sign up for your $1 per month trial period at shopify.com/podcast free. All lowercase. Go to shopify.com/podcast free to upgrade your selling today.